If you're serious about building wealth, there's one thing you need to get right: picking the correct tools to make it all happen. And when it comes to investing, Fidelity has some of the best options out there. But since they offer over 9,000 funds to choose from, how do you know which ones will actually grow your net worth without having to pay excessive fees that will slowly drain your investment account? In this video, I'm breaking down the top 4 Fidelity index funds that can help you fast-track your path to financial freedom by exploding your net worth. First up is the Fidelity 500 Index Fund, FXAIX. It's a low-cost index fund that's designed to track the performance of the S&P 500 index. This means it holds shares of 500 of the largest publicly traded companies in the United States, providing exposure to a broad range of industries like technology, healthcare, financial services, and a lot more. FXAIX is often referred to as a core holding in many portfolios because of its reliable long-term growth potential. It gives investors instant diversification within the largest stocks, which historically have been a consistent driver of stock market returns. With an expense of 0.015%, it's one of the most affordable ways to invest in the US stock market. That equates to 15 cents for every $1,000 invested, which is extremely reasonable. The average returns over the past 1, 3, 5, and 10-year periods have been absolute bananas. While there's no guarantee we'll see these same returns going forward, $10,000 invested into this fund 10 years ago would be worth almost $35,000 today. Since this fund tracks the S&P 500, its performance is tied to the ups and downs of the US stock market. While as we just saw, the S&P 500 has historically delivered very strong long-term returns, it can experience significant short-term fluctuations. It also only includes large-cap companies, so you're missing out on the potential higher growth rates that smaller and emerging companies would provide. Because FXAIX mirrors the S&P 500, it may become heavily weighted towards certain sectors like technology, which currently makes up a significant portion of the index. If tech experiences a downturn for whatever reason, it could overly affect this fund. While this fund does pay dividends, they're generally lower than those from funds focusing specifically on higher dividend stocks, so this one is currently sitting at 1.42%. For investors like me, we don't really care about dividends during the accumulation phase of investing, so this isn't a big deal. But I know some people prefer to focus a lot on dividend returns, so this one might not be for that person. If you're just getting started with investing or are an experienced investor and want a simple, effective way to grow your money over time, FXAIX is a great choice. You're essentially buying a piece of the US economy. It's also perfect for people looking to build wealth over decades, like for retirement, so it works best when held for 5 or 10 plus years. Selling during market downturns can lock in losses, and trading on a regular basis can reduce the fund's upside potential. If you want to set it and forget it with minimal management, this fund works very well since it's a buy and hold investment that rewards a lot of patience. While the stock market does have volatility, large cap companies like those in the S&P 500 tend to be less risky than smaller emerging businesses that you might see in something like a mid or small cap fund. This makes FXAIX ideal for those who want a balance of growth potential and relative stability. Quick disclaimer, as I go through the rest of this list, I am by no means saying to buy all of these index funds at the exact same time to build a well-rounded investment portfolio. That has more to do with portfolio construction. If you want to know my top 5 investing strategies, then I will link that video above my head and down in the description below. If you are enjoying the video so far, then help support my little dog Molly as well as the channel by hitting that like button. Next up is the Fidelity Total Market Index Fund, FSKAX. It's a low-cost index fund that aims to replicate the performance of the entire US stock market, which is why it holds about 3,000 stocks. Unlike the S&P 500 index fund we just talked about, which focuses solely on large-cap companies, the Total Market Index Fund includes thousands of stocks across all market sizes, from large-cap, mid-cap, and small-cap. This makes it one of the most diversified funds available because it provides exposure to a broad range of industries and companies. With how diversified this fund is, is, it allows you to benefit from the growth of both established companies and smaller, high-growth potential companies. It's a great one-and-done fund for all investors. With an expense of 0.015%, it's another cost-effective way to invest in the US stock market. That equates to 15 cents for every $1,000 invested, which is very affordable. The average returns over the past 1, 3, 5, and 10 years have also been very good. The reason why returns are slightly lower than the S&P 500 index fund is because it does hold those smaller companies which haven't performed as well as the 500 largest. Some might consider this a concern with this fund going forward, but keep in mind that just because that's how things played out in the recent past doesn't mean it will continue. As investors, we have to remember to stay focused on the unknown future instead of the known past, because we can't go back and invest for that past. Even if you invested $10,000 into this fund 10 years ago, that money would have grown to $33,000 today, which is only about $1,700 less than if you put it into the S&P 500 index fund. I'd consider that a pretty darn good return. While the broad exposure is an advantage, smaller cap stocks tend to be a lot more volatile. This means that the total market index fund may experience more dramatic swings compared to a large cap only fund. Despite including mid cap and small cap stocks, the fund's performance is still largely driven by large cap companies because they make up the majority of its holdings. The dividend yield is 1.40%, so it's not ideal for investors looking for regular income streams. But if you were like me, then that doesn't really matter. If you are looking for a simple, complete solution that covers the whole US market, the total market index fund can act as a standalone investment and be considered a core holding in most portfolios. I personally like to refer to this fund as the buy and hold investor's wet dream. Because it covers the whole US market, it wouldn't make sense to hold both this fund and an S&P 500 fund at the same time if you don't have to. So pick one or the other. FSKAX is ideal for investors seeking a balanced mix of company sizes, ranging from giants like Apple, Google, and Facebook to small emerging businesses most of us have never heard of. It's also ideal for those with a long time horizon because it captures the growth of the entire market over time, which has historically delivered very solid returns. Unlike funds that may be concentrated in specific sectors, FSKAX spreads its exposure broadly across industries, which reduces the risk of any one sector dominating your portfolio. Next up is the Fidelity Total International Index Fund, FTIHX. It's a low-cost index fund designed to track the performance of the global stock market outside of the United States. It invests in a mix of developed and emerging market stocks, giving you exposure to over 5,000 companies from regions like Europe, Asia, Latin America, and many more. International markets often perform differently from US markets. By including this fund in your portfolio, you can reduce your reliance on the US economy and tap into growth opportunities across the globe. It's an important building block for achieving global diversification. The cost of this fund comes in at 0.06% per year, which is 60 cents for every $1,000 you have invested. This fund hasn't been around for 10 years, but the 1, 3, and 5-year average returns aren't great. $10,000 invested into this fund since it was created 8 years ago would have grown to $17,500, which might make you question why in the world I'd put this fund on my list of top Fidelity index funds. It's no secret that international stocks have significantly underperformed compared to US stocks in recent years. US markets, especially large cap tech stocks, have been the dominant driver of global returns. But this doesn't mean that you should skip international exposure. No single market leads forever. While US stocks have been dominant recently, history shows that leadership can shift. International markets may outperform in the future, and you'll want to be positioned when that happens. US stocks and international stocks often perform differently under various economic conditions. Holding both reduces the risk of your portfolio being overly reliant on one market. Many international markets are trading at lower valuations compared to the US, which could signal better long-term growth potential. Some things to be aware of with this fund is that international markets, especially emerging markets, can be more volatile than the US market due to factors like political instability, economic fluctuations, and currency risks. While the fund is diversified globally, it's often weighted more heavily towards towards certain regions such as Europe and Asia. This could lead to regional concentration risks. International markets sometimes take longer to recover compared to the US after economic downturns, so you're going to need to be able to hold on to this fund during the good and bad times. While some international companies do pay dividends, and this fund is currently sitting at 3.18%, they're not typically as high or consistent as those from US dividend-focused funds. This fund is for the investor who is heavily weighted towards US stocks and wants to become more diversified. FXAIX helps balance that by adding exposure to international markets. It's also ideal for people with a long time horizon because international markets, as I said before, can take time to recover and grow, but they do have significant potential for long-term gains. Emerging markets in particular have high growth potential, and this international fund gives you exposure to these regions along with more stable developed markets. A ton of US investors have no interest in holding any sort of international stocks, and I get it because I used to be one of those people a few years ago, but I've since changed my mind. If you want to hear my thoughts on why, then down in the description I'll link a video where I go into more detail. I do want to mention that Fidelity offers two other international index funds which I don't really like as much as FXAIX. Both actually cost less, coming in at 0.035% and 0.055% versus the 0.06% fee charged for FXAIX. The reason I chose to keep these two off the list comes down to the number of stocks held within each of them. Here's the number of stocks in each. I personally prefer a fund that is more broad and holds more stocks, as opposed to one that is more narrow to get as close to the average market return as possible. Since FXAIX meets that criteria, I prefer it over the other two. Since the fees for all three are extremely low, I'm personally okay with paying a little extra to get exposure to a lot more stocks. If you're someone who cares more about cost than anything, then FSKAX would be my number 2 pick, and FSKAX would be my third. There's something great about a very hands-off approach to investing, which is why Fidelity Freedom Index funds make my list. They're target date retirement funds that automatically adjust the asset allocation over time to align with the investor's anticipated retirement year. Each fund is named for its target year in 5-year increments, going from 2010, which is for someone who retired that year or around that year, and currently ending in 2070 for investors who are many years from retirement. These funds use a glide path strategy, meaning that the asset allocation continues to adjust even after the target date, with the goal to balance growth and income preservation during retirement. The glide path is based on research into retirement behaviors, which focuses on long-term goals like continued growth during working years and capital preservation while in retirement. Fidelity's Freedom Index funds balance exposure across multiple asset classes, including US and international stocks, bonds, as well as investments that adjust for inflation to manage risk and maximize returns. These funds are designed to address the risk of outliving your retirement savings by providing a steady and sustainable income throughout retirement. The Freedom Index funds simplify retirement planning by providing a diversified do-it-for-me solution, which is why they are so appealing to a lot of people. Since the underlying funds held within each Freedom Fund is made up of other low-cost options from Fidelity, they charge a low fee of 0.12%, which equates to $1.20 per $1,000 invested. Returns are going to vary depending on the target year you choose, so let's just choose the 2045 fund to look at the 1, 3, 5, and 10-year returns. $10,000 invested 10 years ago into this fund would have grown to a little over $24,000 today. A few things to be aware of with these funds is that they may become too conservative for some investors, leading to and after retirement, potentially limiting growth opportunities. This is one of the biggest knocks on them by myself and a lot of other people out there. Because of that, a workaround is to continue to choose the furthest out target date fund when they become available every 5 years. At this point, that's the Fidelity Freedom Index 2070 fund. Another is that while the funds are designed for the average investor, they may not perfectly align with your specific financial situation or objectives. For someone like me who has a higher risk tolerance during the wealth accumulation phase, I personally prefer a 100% stock-based portfolio, but not everyone can handle that sort of volatility. The last thing to be aware of is that the Fidelity Freedom Funds simplify investing but do not guarantee enough retirement savings. As with any funds, there are no guaranteed returns here. That's why consistent contributions are still important to achieve your retirement goals. The Fidelity Freedom Index Funds are great for investors who want a simple, hands-off investment solution tailored to many different retirement goals. They're also ideal for people who prefer not to manage or rebalance their portfolio manually over time. Just set it and forget it. And finally, with an index-based approach, these funds offer low expense ratios compared to actively managed target date funds, which, to be honest, we are not fans of around here. If you want to know why I left off the Fidelity zero fee funds from this list, as well as my top 5 investment portfolios to explode your net worth, then check out these videos to your left next. Hit that like button before you go. I'll see you in the next one, friends. Done.